So open April 2024 question number 2. Then once you have it, you can inform me, yes, we have it. Yes, we have it. Then from there, we can start. Remember yesterday I indicated we'll look at cash flow statements, but we won't start cash flow statements today. We'll start next week. We'll start cash flow statements next week. So hopefully that is when in this case we'll be winding up with the topic of published. We'll wind up with the topic of published financial statements next week. So for today, we're going to look at this particular question here. We're going to look at this particular question here, and we'll finish a bit early. We'll finish a bit early because there's something I have to attend to. There's something I have to attend to. We might finish a bit early. I think by around 7, we'll likely be through. We'll likely be through. So, so I can see you saying. I can see Michelle says yes. I can see Titus says yes. Evans, do you have that question? Confirm whether you have the question. I want us to start immediately. April 2024, question number 2. April 2024, question number 2. Faith, do you have the question? So that's what I'm having to ask. You need to indicate there whether you have the question. Only 2 people have been able to get the question. Only 2 people have been able to get the question out of 16. Out of 16. Faith says yes. She asked the question. She asked the question. She asked the question. So we can start looking at it. We can start looking at it. So it says the following trio balance was extracted from the books of 𝐜𝐿𝐵 Limited as of 31st of March 2024. We've been given some equity items there plus revenue. We've been given some expenses there, cost of sales, distribution cost, admin expenses. Then, of course, the closing inventory, trade receivables, trade payables, bank balance, deferred tax. Then property at cost. Property at cost, which includes land of 87 million. Then you've also been given plant and equipment at cost, motor vehicles at cost, fixtures and fittings at cost. Then there we have the accumulated dips. The accumulated depreciations are also in this case being provided for there. The accumulated depreciations have actually been provided for there. Then you are given additional information. There's of course interest paid, and then there's a suspense account. Additional information, you are told, during the year ended 31st of March 2024, the company sold off an item of plant with a carrying amount of 46,200. Seems this idea of plant having to be sold is very common. This idea of plant having to be sold is very common. So we are told in this case, the carrying amount of this asset was 46,200,000 for cash proceeds of 42 million. The disposal proceeds were credited to the suspense account. Plant and equipment is depreciated at the rate of 12.5% per annum on reducing balance. Full year depreciation is provided in the year of asset purchase and none in the year of water disposal. Depreciation and any gain or loss on disposal of plant and equipment should be classified under the cost of sales. Then you are told depreciation on other non-current assets is provided and allocated as below. So you are given buildings at the rate of 2, motor vehicles at the rate of 25, fixtures at the rate of 10. All of them it is straight line. That means it is actually what on cost. Then you are told where you're supposed to allocate those expenses. Then the 8% loan note was issued on 1st of April 2023 and will be redeemable in 3 years' time at a substantial premium, which gives an effective interest rate of what 10% per annum. So of course you'll be able to calculate interest on that loan, so which will become the finance cost. There are 2 rates there. We have 8% and 10%. We'll use 10% because I'll be able to explain to you why we'll be able to use 10%. Then in this case, you have matters regarding what tax. Tax provision for the year 31st of March 2020, which is the year we are having to account for, was determined to be a tax credit, estimated at 15.7 million. In addition, as of 31st of March 2024, the tax basis of assets and liabilities exceeded their carrying amounts by 121 million. The income tax rate applicable to 𝐜𝐿𝐵 Limited is actually in this case 30%. So from there, we need in this case to determine the income tax expense. The income tax expense. What are you required to, in this case, to calculate? You are required in this case to prepare what you call a property, plant, and equipment movement schedule for the year ended 31st of March 2024. Then in this case, a statement of profit or loss for the year ended 31st of March 2024. So that's what in this case the examiner wanted us in this case to come up with. So these are items of what? Items of published financial statements. Items of published financial statements. So of course, the property, plant, and equipment will come under the disclosures or the notes to the financial statements. Then, of course, profit and loss is part of the key components of the published financial statements. So you're going to look at, in this case, how you could have actually been able to come up with that property, plant, and equipment movement schedule. Then in this case, how you could have actually been able to prepare the statement of profit or loss, statement of profit or loss. So we can, in this case, start by having to, in this case, look at, we can start by, in this case, having to look at what the property, plant, and equipment meant schedule. So we can see 𝐜𝐿𝐵 Limited, 𝐜𝐿𝐵 Limited. So that is the first pattern. 𝐜𝐿𝐵 Limited, 𝐜𝐿𝐵 Limited property, plant, and equipment, property, plant, and equipment schedule. It is for the year ended, it is for the year ended 31st of March 2024. 2024. So you need always, in this case, to be organized. You need to start with the title. You need to start with the title. You need to be very organized. You need to be very organized. You need to be very organized to start with what? The title. You need to start with the title. So in this case, we have like in this case, you need to identify the items of property, plant, and equipment you have. These ones you can be able to identify them from, in this case, what the share balance. So we have in this case property, we have plant and equipment, we have motor vehicles, and you have what? Fixtures and fittings. So we can in this case start with property here. We can have property here. We can start with property there. Then we can go to plant and equipment. Plant and equipment. Then after plant and equipment, we have motor vehicles. We have motor vehicles. Then we have fixtures and fittings. Fixtures and fittings. Fixtures and fittings. Then our figures are having to be reported in thousands. Our figures are having to be reported in thousands. So that will be, in this case, be what our property, plant, and equipment movement schedule. Property, plant, and equipment movement schedule. So here basically it is what the details for the particulars. So what will happen here, we'll actually in this case start with the costs of these assets. The cost of these assets at the start of the year. So the cost of these assets, this is by first. The start of the year was actually 1st of March. Is it 1st of April or March? It is 1st of April. 1st of April 2023. It is 1st of April 2023. And these ones you can actually be able to get them in the share balance. You get them in the share balance. For example, for properties is 457 million. 457 million. Then for plants, it is actually 360 million. For motor vehicles, it is 82 million. Then for fixtures and fittings, it is actually 64 million. 64 million. Exactly 64 million. Exactly in this case, 64 64 million, 64 million, 64 million. So of these items, if you look at note number 1, there was a disposal. So in this case, under note number 1, there was in this case what? A disposal as per note number 1. It was of in this case what? Plant. It was actually in this case of plant. So plant. It is of plant. So how much of these items ended up having to be sold? It was in this case 46,200. 46,200. So when they were having to be sold, that was their carrying amount, 46,200. 46,200, 46,200. So there were no items for these other ones which were sold. So 46,200 was actually in this case sold. 46,200 was in this case sold. 46,200 was actually in this case sold. Then you have in this case accumulated depreciation, sir. Accumulated depreciation, sir. Accumulated depreciations on these items. So accumulated depreciation on these items. So this one's also actually been given. So this was like in this case for the first one. Remember, this one is made up of land and buildings. This one is made up of land and buildings. So for the first one here, you've actually been told they had an accumulated, by the start of the year, they had an accumulated depreciation of 162,800. So we should be able to deduct so that in this case, you can be able to know how much was having to remain as the net book value by the start of the year. This one was for plant, it was 119,400. 119,400. 119,400. Then for motor vehicles, it is 41 million. Then for this other item of fixtures and fittings, it is 25,600. It is 25,600. So we can be able to get what were remaining as the NBVs at the start of the year. So the NBVs, by the time you're having to start the year, they were actually in this case, how much? You can get the difference between the two. You can actually, in this case, get the difference between the two, So for this one, 457 minus 162,800, you get 294,200. So 294,200. What about for plants? 360 minus 46.2 minus 119.4. 360 minus 46.2 minus 119.4. You get 313. Not really. Can't be 313. It can't be 313. It can't be. Can't be. You need to minus the two figures, 46,200 and 119,400. It comes to 194,400. 194,400. 194,400. What about this one? This one comes to 41. This one comes to 41. Then this other one, 37 or something. 38,400. Is it 38,400? It'll be 38,400. 30. This one should come to 38,400 when you do the mathematics there. 38,400. 38,400. So these were the carrying amounts by the start of the year. The carrying amounts by the start of the year after they had actually been able to dispose of what the items. They had actually been able to dispose of what the items. They had actually been able to dispose of what the items. Then if you look at note number 2, you were actually in this case being told how they were having to depreciate. But before that, look at note number 1. There's this particular plant. There's something I told about plant. So of course, you've actually been able to account for this 46, which was actually sold. You're told the disposal proceeds were credited to the suspense account. Of course, you can see a suspense account and the TO balance of 42 million. Then plant and equipment is depreciated at the rate of 12.5% per annum on reducing balance basis. Full year depreciation is provided in the year of asset purchase and none in the year of what? Of disposal. So we in this case need to compute what? The depreciations. We need to compute the depreciations. So the depreciations, we need now in this case to deal with the depreciations. So of course in this case we can actually be able to start with what? for plant. For plant, we can say in this case with that one for plant. So in this case, we can maybe have our small workings here. So you can say in this case with plant. So for plant, we've actually been told is on reducing decibel. It is on reducing balance basis. So it means you take what you calculate on this net book value. You actually reduce it. You take 360 minus this, then also you set off those ones which were sold like that. Of course, you haven't actually been told the accumulated dip on these ones, but just set them off to get how many of these plants were having to remain. It was 119,400. So it means in this case, the workings for depreciation, so the workings here for our depreciation for plant, it will likely be 12.5%. You multiply by 194,400. 194,400. 12.5%, you multiply by 194,400. There's a figure you'll be able to get. There's a figure you'll be able to get. There's a figure you'll be able to get. What do you get when you do the mathematics there? You get 24,300. 24,300. You get 24,300. So it means in this case, we'll actually come here and say 24,300, which we need in this case to deduct. So you get in this case 24,300. This one, there's something you've actually been told about it. So depreciation and gain or loss on disposal of plant and equipment should be classified under cost of sales. So this one will actually go to the cost of sales. This depreciation should actually end up having to go to the cost of sales, cost of sales. Then also you've been told if there is a gain or loss on disposal of plant and equipment, it should be classified under cost of sales. So if this item had a carrying amount of 46.2 million and we sold it at 42 million, did we realize a gain or we realized a loss? Did we realize a gain or we realized a loss on sale? Did we realize a gain or we realized a loss on sale? It had a carrying amount of 46.2, but we ended up having to sell it for 42. Did we realize a loss or we realized a gain? We realized what? A loss. We realized a loss. So in this case, loss on disposal of plant. The loss on disposal of plant is likely to be 46,200 minus 42, which will likely end up having to come to 4.2. It will come to 4.2, which in this case, we're having to say it will likely go to the cost of sales. You have to take note, it will go to the cost of sales. It will go to the cost of sales. So that's in this case, you can be able to deal with that. Then you look at note number 2. There's depreciation in this case, on buildings. Depreciation on buildings. There's depreciation on buildings. So for buildings, you've actually been told is 2% on straight line. So for building, we'll take what? 2% multiplied by 2% multiplied by what? For buildings, we'll take 2% multiplied by what? 2% multiplied by what? For buildings, we'll take 2% multiplied by which figure are we going to place there? It is 2% multiplied by it is 70. It's supposed to be 370 because if you look at what you've been told about property, you've been told property comprises of 2. We have land in it, which is of how much? 457 million. Or 87 million, sorry. So it means you'll have to deduct. When you deduct, you'll be able to get 370. Land, its cost was actually 370. And therefore, when you take 2% of this, what you get? 2% of that. When you take 2% of that, what do you end up having to get? 2% of that, you get what? That's 2% of that. 0.02 times 37. Get 7,400. You likely end up having to get 7,400 like that. So it means in this case here, depreciation on, in this case, buildings, which will go in this column, will likely in this case be 7,400. And you need in this case to take note where you've been told this particular depreciation will go. You've actually been told in this case on buildings, it will likely go to, in this case, what are the mean expenses? It will go to admin expenses. It will go to admin. It will go to admin expenses. It will likely go to admin expenses. So you can in this case go now in this case to motor vehicles. You can go to motor vehicles. So for motor vehicles, you are told it is 25% still on straight line. So we'll take in this case 25% multiplied by the cost of motor vehicles, which in this case is 82 million. Which in this case will likely be equal to 25% multiplied by 82 million. What do you get? 25% by 82 million. So that is motor vehicles. Motor vehicles. 25% of 82 million, you get 2,500. So motor vehicles, it is 2,500 like that. 2,500. 2,500. But take note where you've been told it has to go. It goes to distribution. This expense will likely go to distribution. So after motor vehicles, after motor vehicles, we have fixtures and fittings. We have fixtures and fittings. These ones, you are told we depreciate at 10%. So fixtures and fittings. So we go to fixtures and fittings. Fixtures and fittings. These ones we depreciate at what? At 10%. So we'll take 10%, multiply by 10%, multiply by the cost. Because it is straight line, it simply basically means it is on the cost. So it is actually 64 million. So we'll take that multiplied by 64 million. We'll get 6,400. This one, you clearly be told it will likely go to admin. It goes to admin expenses. It will go to admin expenses. It will go to admin expenses. So we can come here and actually say on fixtures. So fixtures and fittings. Fixtures and fittings, it is an amount of 6.4. It's an amount of, in this case, how much? 6.4 million. 6.4 million. And therefore, with these ones, then in this case, you can be able to get the balances of the property, plant, and equipment by the end of the year. So the carrying amounts by the end of the year, we can be able to get them. The carrying amounts by the end of the year, we can easily get them. So we'll have the carrying amount at the end. Carrying amount at the end. And therefore, you need to deduct to get the difference. So we'll take 294,200 minus 7,400. 294,200 minus 7,400. You get 286 something. 286,800. 286,800. 286,800. You'll be able to get 286,800. Then 194,400 minus 24,300. You'll get 170,100. 170,100. Then this one, 41 minus 2,500, you get 2,500. Then 38,400 minus 6,400, you get 32 million. You get 32 million. Of course, that's why you could have actually been able to come up with what that particular schedule. Could have actually been able to come up with that particular schedule like that. So that's what the property, plant, and equipment schedule. Property, plant, and equipment schedule. Property, plant, and equipment schedule. So Hope you are through because I want to wrap. I want to wrap so that we can move to the next one, statement of profit or loss. Can see Catherine says there, wait. Catherine says there, wait. Catherine says there, I wait. Catherine says there, I wait. I can see she says okay. I don't know if there's another person who's still left behind because I want to wrap. We move to the profit or loss statement. Profit or loss statement. I want us to move to the profit or loss statement. So statement of profit or loss. So a statement of profit or loss. So you can in this case start looking at the statement of profit or loss. So it is Q&2 Limited. So Q&2 Limited. Q&2 Limited. The 31st of March 2024. So we can in this case have our shillings in thousands. Our shillings in thousands. So with our statement of profit or loss under public financials, as we said, in this case, you start with what? Revenue. You can start with the revenue. The revenue actually been given. It is there in the TO balance. It was coming to 1783,800. So it doesn't have in this case any form of adjustment. And therefore, we'll just be able to pick it the way it is. So 1783,800. 1783,800. So 1783,800. So in this case, you now less on this one, what we call cost of sales. You less on this one, cost of sales. So the cost of sales, we've actually been told we adjust with what depreciation on plant. Then the loss on disposal of sale of plant. Remember in note number 1, what you've just been able to write under the workings here. You've been told you adjust with 2 items. We have depreciation on what? On plant, and of course what? The loss on sale of what? Of plant. So as per the TO balance, what you've actually been given as cost of sales, it is 1300,500. 1300,500. But now we have to, in this case, do what? Add on. We have to add on loss on what? Sale of that item. It was 4,200. Also, we are supposed to add on the depreciation on that item, which you calculated, and you've actually gotten how much? 24,300. Gotten 24,300. 24,300. So what you get, you need to add so that you can get the total cost of sales, because this part of 2 expenses you've actually been told that we add on the cost of sales as per note number 1. So what do you get when you total? They don't mark the workings, they mark entries only. They don't mark workings. They mark only entries. They mark these fine figures entries. They don't mark workings. Workings are to help you get these figures. So what do you get as the total there? 1329 000, 1329 000, 1329 000. So you deduct there. So what do you get in this case as the GP? You can actually be able to now in this case get the gross profits. What do you get as the gross profit? What do you get as the gross profit? The gross profit. $454,800. I can just say $454,800. Then we can go now in this case to what? To admin expenses. Admin expenses. So for the admin expenses, also we've actually been told we adjusted them. We've actually been told we adjusted them with some depreciation there. You look at the TIO balance, what you have as admin expenses, it is 258,600. 258,600, but we have to add. We are told in this case we add the depreciation on buildings and of course the depreciation on what? On fixtures and fittings. We need to add those two what figures. So we had 7,400 and of course what 6,400. So 7,400 plus 6,400. These two figures you are told you add them. So when you add, what do you get? When you add them, what do you get? So for admin expenses, you adjust with these two items. They were supposed to go to admin expenses. So you need to add them. 272,400. You will be able to get 272,400. 272,100. This one we are deducting. Then we can go to distribution expenses. Distribution expenses. These ones also you've actually been told to adjust. So of course, what you've actually been given as per your balance. It is actually coming to 209,900. 209,900. But you have to add on motor vehicles depreciation. Motor vehicles depreciation, which in this case we were getting how much? 2,500. We were getting 2,500. We need to add on that depreciation on motor vehicle, which we are getting 2,500, and therefore in total, we have what? When we add, we have, I can see you're saying 230,400. 230,400. So 230,400. So the other expense you'll be able to put here, obviously in this case, is exactly what we call what? Finance cost. So it is finance cost. Finance cost. So for the finance cost, there is a loan that was actually there. There's a loan that was actually there as per note number. There's a loan that was actually there as per note number 3. Look at 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 note number 3. You are told the 8% loan note. There's a 8% loan note which was issued. If you look at the TIO balance, there's a 8% loan note. 8% loan note. Which in this case, they ended up having to use to do what? To borrow some money there. 120 million. They borrowed 120 million. The 8% loan note was issued on 1st of April. They issued at the start of the year on 1st of April 2020. Remember, we are accounting for after a year. So they issued at the start of the year. It means this loan note had existed for an entire year. By the time we are preparing what? The financial statements. It had existed for the entire year by the time we are preparing what? The financial statements. This is what you're told about the loan note. The 8% loan note was issued on 1st of April and will be redeemable in 3 years' time at a substantial premium, which gives an effective interest rate of 10% per annum. It will be redeemed. It will be redeemed. So it won't exist for the entire life of the company. It means after 3 years, the entire principal amount plus the interest must have actually been settled. Must have actually been settled. They must have actually been able to close on that what liability. They must have actually been able to close on that what liability after 3 years. But there's something you're told about in this case. You are told that in this case, of course, it will be redeemed in 3 years' time at a substantial premium. At a substantial what? Premium. So the amount at which they'll be able to redeem it, it will be at an amount over and above the rate they had actually provided as what? As interest. It will be at an amount over and above the rate they had actually provided as what as the rate of interest. They provided in this case rate of interest of what 8%. But now when they'll be redeeming, if you look at the entire effect, they'll actually end up having to pay a total of 10% interest because they'll actually be redeeming it at an amount over and above what in this case was the par value of the loan note. So the overall effect here, what they're having to mean here, the interest you are supposed to be able to recognize in the books of accounts, it is plus that interest that has already what the premium. Therefore, our finance cost here will actually calculate it at 10%. Because that is the overall effect that the company will be able to suffer in terms of interest will be 10%. Because they'll be redeeming, and this will give an effective interest rate of how much? 10% per annum. So our finance cost here will actually be 10%. You multiply in this case by that amount. It was 120 million. You should be able to get 12 million. If you actually get in this case what? 12 million. You get 12 million. You'll actually get 12 million. You get 12 million. You'll actually end up having to get what? 12 million. You get 12 million. So you can actually be able to calculate and actually find out, are we having to get a profit or loss before tax? Profit or loss before tax. What are we getting as a profit or loss before tax? What are we getting as a profit or loss before tax? What are you getting as a profit or loss before tax? Can see 60 million loss. It is a 60 million loss. It is a 60 million loss. It is a 60 million loss, upon which in this case we are supposed to, in this case, charge what? Tax. We are supposed to charge tax. So our matters pertaining tax, our matters pertaining in this case, how we'll be able to deal with tax, it is as per note number 4. Look at 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 note number 4 very keenly, and you listen to what you're having to say here. Look at note number 4 very keenly, and you listen to what we are having to say here. Look at note number 4 very keenly, and you listen to what we are having to say here. So this is what you are told about in this case under note number 4. The tax provision for the year to 31st of March 2024 was determined to be a tax credit estimated at 15.7 million. The tax provision. So in our previous questions, you've actually been coming about what? Tax provided. The tax was in this case was actually provided for that particular year was actually this much. And of course, that's what you've been able to say that in this case, it comprises what? The current tax. It comprises what? The current tax. It comprises the current tax. So it means this is actually what? One of the components of what? Of income taxes. In our previous questions, we've been coming across a situation whereby you're just told that the tax provided for the current year, the current tax provided for the current year is this much, which actually ends up having to be what? To be like an expense, which you have to include in what? In the income tax expense. But here, this is what you're having to be told. Tax provision for the year ended 31st of March. This year, we're having to account for this year. The tax provision for this year, we're having to account for, it was what? A tax credit estimated at 15.7 million. So much importance here. It is to be able to understand what is actually what a tax credit. You need to understand what is a tax credit. What in this case is actually what? A tax credit. So we can actually be able to just in this case indicate. Besides, you need to indicate or put a working. Then in this case you write as per what? Note number. It is note number 4. As per note number 4, you write NB. Write NB. Write NB. Then you write this. Write NB. Then you write this. You write this. Tax credit is a benefit. Tax credit is a benefit. Tax credit is a benefit. Tax credit is a benefit that reduces the amount of tax that reduces the amount of tax. Tax credit is a benefit that reduces the amount of tax to be paid by the company. To be paid by the company. Tax credits is a benefit that reduces the amount of tax to be paid by the company. 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 To the government. To be paid by the company to the government. To be paid by the company to the government. To be paid by the company to the government, comma, to be paid by the government, the company to the government, comma, directly lowering the tax liability. 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 Full stop. You can write and say it can arise as a result of. 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 Over provision in the previous years. It can arise as a result of. Over provision in the previous years. And result as a result of. Over provision in the previous years. In the previous years. Over provision in the previous years, or tax benefits advanced to, or tax benefits advanced to, or tax benefits advanced to the company, or tax benefits advanced to the company by the government, or tax benefits advanced to the company by the government, or tax benefits advanced to the company by the government, or tax benefits advanced to the company by the government, advance 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 to the company by the government. Then you say full stop, Then that's why in this case what you mean by the tax. So it means in this case, this figure you've actually been given as 15,700. It is a tax credit, it is a tax benefit. It's not really an expense, it's like a benefit, it's like an income. So what will happen here, what will likely end up having to happen here, we won't actually deduct it here, we'll add it here. Because it's what is a tax benefit. So we'll actually add it back there. We'll actually add it back there because it's not like in this case of an expense, it's like a benefit you are having, it's like an income or an inflow you are having. So we won't actually end up having to deduct it as an expense because it's what is a tax credit. Is a tax credit? Is a tax credit. So that's what you mean by a tax credit. That will be the effect. We'll add it here. So you can go to, in this case now, the other part of the deferred tax. The other part of the deferred tax, which in this case, you are told, in addition, on 31st of March 2024, the tax basis of assets and liabilities exceeded the carrying amounts by 121,000. The tax basis of the assets and liabilities exceeded their carrying amount by, in this case, what, 121,000. 121,000. So what they mean there, so you just continue after being able to write that, you can be able to write and say, the deferred tax, in this case, which in this case is normally equal to, in this case, what? The carrying amount minus the tax base, the carrying amount minus the tax base, which was supposed to multiply by 30%, was actually in this case equivalent to negative. When they calculated this one, they got a negative. They go to a negative. You can go see what they're having to say there. Just listen to the statement very carefully and look here what you're having to say here. To get the deferred tax here, we normally get to, in this case, what we call what the temporary differences. We normally in this case get what the temporary differences. The temporary differences. And how do we get them? It is actually in this case current amount minus the tax base. Then in this case we multiply by what? By 30%. So it means in this case the deferred tax here was actually the carrying amount, you can put it in brackets, minus the tax base, we multiply in this case by what? By 30%. By 30%. So the deferred tax is equal to the carrying amount minus the tax base, multiplied by what? By 30%. In our situation here, the carrying amount minus the tax base, actually it was in this case having to give us what? Negative 121,000. It was giving us negative 121,000 like that, negative 121,000 like that, negative 121,000 like that. So you are told in this case, in addition, as at 31st of March 2024, the tax basis of the assets, these tax basis of the assets and liabilities exceeded the carrying amount. These ones were more than the carrying amount. If these ones were more than the carrying amount, it means what you'll be able to get here as the net effect will be what will be a negative. When this figure you are minusing is more than the one you are subtracting from, you normally get what? A negative. So we are having to say that in this case, according to what you're having to be told here, the tax basis of the assets and liabilities, the tax basis exceeded, they were more than the carrying assets, the carrying amount, sorry, by in this case, how much? 121,000. It means the net effect as the temporary difference as the TD, which is this one, we were getting what? A negative. We are having to this case get what? A negative. Or in this case, how much? 121,000. 121,000. And then in this case, we say if it happens that in this case the temporary differences end up having to be negative, what you eventually get here is not a tax liability. We call it what? A deferred tax asset. We call it what? A deferred tax asset. Whenever in this case the TD is negative, you don't call this one what? A tax liability or a deferred tax liability. We call it a deferred tax what? Asset. So this one was what? A DTA. Was a deferred tax what? Asset. It was in this case what? A DTA. It was a deferred tax in this case what? Asset. Deferred tax asset. Whenever in this case the TD or the temporary difference ends up having to be negative, what you eventually get here is a deferred tax what? Asset. The net effect will actually bring us what? A deferred tax asset when you get 30% of it. If it's a positive, is when now we call it what? A DTL. A deferred tax what? Liability. Is when we call it what? A deferred tax what? Liability. And therefore in this case, we can actually be able to look at what was happening here, what was actually happening here. So if you look at in this case the TO balance, if you just look at the TO balance, look at the TO balance. If you look at the TO balance, there's a figure of deferred tax, and of course it is not on the credit side. This time it is actually or not on the debit side. So if in this case we are having the deferred tax accounts, if you are having the deferred tax account, it means in our situation here, what we have is an asset. What you have is an asset because the balance is actually what? On the debit side. Why it's on the negative side, it would have actually been a deferred tax liability. It would have actually been a deferred tax liability. But now, in this case, the balance is actually what? On the debit side. Exactly the debit side. It means in this case, by the time we are starting the year, in this case, the deferred tax asset balance, by the start of the year, the balance brought down. In our situation here, it was actually in this case an amount of 33. Why it's on the credit side, it would have been a liability. You would have put this side. This opening balance in the deferred tax account, you would have put this side. But in our situation here, we've actually been told it's on the debit side, meaning it was an asset. Because assets are the ones that in this case have what? A debit balance. Were we told in this case, in the TO balance is on the credit side, it would have actually in this case been what? Been a liability. It would have actually in this case been a liability. And therefore, we've actually been able to calculate. You've actually in this case calculated there. You've actually calculated in there the deferred tax what? The temporary differences you've actually gotten it as having to be what? Having to be negative, having to be negative. Meaning that in this case, this temporary difference will give a result of what we call a deferred tax asset by the end of the period. Remember, this one is the deferred tax asset at the start. What you've been given in the additional information should be able to give us what? The deferred tax by the end of the period. By the end of what? Of the period. By the end of the period. And of course, the balance carried down for an asset is normally in this case or not on the credit side. Let's assume you are preparing in this case what? An equipment account. Let's assume you are preparing an equipment account. If the balance brought down here, because obviously assets normally have a debit balance. But when you are getting the balance carried down at the end of the year, it's normally this side. It will come here. The balance carried down will actually come here. So same case. This one is what? A deferred tax what? Asset. And what you are getting as the net effect by the end of the period also, it is bringing to us what? A deferred tax what? Asset. And therefore, it means this balance by the end of the year in the deferred tax account will likely be on this side because this one is what? An asset. So you'll have here a balance carried down of 30% of this. You need to get 30% of this because this is what you defer tax. To get the deferred tax, you normally take what? Tax rate multiply by the temporary difference. These are temporary difference. But now to get the deferred tax on it, we need to take what? 30%. So we'll in this case say the balance carried down is actually 30% multiplied by, in this case, our 121,000. What do you get? 30% multiplied by our 121,000. What do you get? This is a figure you'll be able to get there. 36,300. You'll be able to get 36,300. So 36,300. 36,300. 36,300. 36,300. You'll be able to get 36,300. 36,300. Once you have this, you can actually be able to balance, in this case, what? Your deferred tax account. Which side is actually more? This side is actually more, so you'll be able to put here the total. We'll actually put here the total. It will be 36,300. We'll put here the total. It is 36,300. Then we get what? The balancing figure. We get in this case what? The balancing figure. We get the balancing figure. We get the balancing figure. We get the balancing figure. This balancing figure, it will likely go to the income statement or the P&L account. It will go to the income statement or the P&L account. And of course, the difference is how much? 33. It is 3,300. 3,300. Meaning, when it goes to the P&L account or the income statement, this figure, will it be an income or will it be an expense? Meaning, if it goes to the income statement, this particular figure here, will it be an income or will it be an expense? Try to think out loud, think out loud. If it is here on the debit side, when it goes to the income statement, will it be an income or an expense? I can see people are saying expense. I can see people are saying expense. It will be an income. It will be an income because we'll actually complete the double entry in the P&L account by having to do what? Credit the P&L account. Remember, when you debit here, when you go to the respective corresponding account, you do what? You credit it because you are debiting here. You go and actually credit. Any credit entry in the P&L account is an income. Any credit entry in the P&L account is an income, or in the income statement is an income. Any debit entry in the P&L account is an expense. It's normally this. We normally debit expenses in the P&L account. We credit incomes in the P&L account. It's just logic that in this case, if this one account is having to be debited, what is double entry? The corresponding account, you do what? You credit. And when you credit in this case, the P&L account, it means it is an income there. But if it happens, this P&L was actually here, it means we would have been debiting what? The P&L account. Debit entries in the P&L account will likely end up having to mean in this case, it is what? It is an expense. It's an expense. For example, what I mean by this cost of sales here, although we are presenting it like this, but if you do a T account, it means in this case, this cost of sales we are debiting is an expense. These are admin expenses we are debiting is an expense. This distribution expenses we are debiting is an expense. This one we are debiting. This revenue we are crediting because it's like an income. It is increasing what is in the profit and loss. Is increasing. Let's assume we had something else here like rent received. rent income, that would have actually been what? A credit, because it is increasing here. So it means if here we are having to debit here, in the corresponding account, which is the P&L account, we are crediting double entry. If it's a credit entry in the P&L account, it means it is what? It is an income. It is an income. So that's how in this case you'll be able to present using what? The deferred tax what? Account. So let me just in this case try to explain something here, because sometimes you can be able to use these T accounts, or you can just in this case think logically. Then in this case you can actually be able to do what? Understand how you treat this figure here. Because what it means, if this one is an income, it means you'll likely end up having to add on that current tax credit. Then overall, we'll get what? The total benefits to the company, we add them here. Because this one is an income, it means it will likely increase the tax benefits of the company. One of the tax benefits is on the current tax, which you've already been able to define. That amount you've been given. We have to add on this one because it's an income, then we'll end up having to add here. So overall, these two figures in the deferred tax account as an income, plus that current tax credit, will add the two figures. It will be a benefit to the company. It's like an inflow to the company. So in this case, we won't deduct, we'll actually add them here. It won't be an income tax expense. It will be an overall income tax what? Credit. Income tax what? Credit. So there's something about, in this case, deferred tax what? Assets. You know, in this case, we have deferred tax assets and we have deferred tax what? Liabilities. In our previous two questions, we dealt so much with what? Deferred tax what? Liability. If you are very keen, in our previous two questions, we dealt so much about what? Deferred tax what? Liability. Deferred tax liability. And of course, there I was having to ask you, you need to compare the deferred tax liability at the start and the deferred tax liability at the end, which in most of the instances we do compute like the way we've been able to compute it. Although here it is an asset, it's not a liability. We need to, in this case, compare what? The deferred tax liability at the start, deferred tax liability at the end. That is the sum we were having to sing in what? In our previous two questions. And I was having to tell you that in this case, you need to just compare the two figures. If it's a DTL, not a DTL, take note. In our previous two questions, we were dealing with the deferred tax liability. It was a liability. That simply means that in this case, our temporary difference here was a positive. If you take the carrying amounts of the assets and the tax basis of the assets, the temporary differences we were getting in those questions were positives. If it's a positive TD, it brings about what? A deferred tax what? Liability. And if it was a deferred tax liability, at the start, we would have placed it here. Then deferred tax liability at the end would have placed it here. This figure would have been here because liabilities, their balances at the end are normally this side. With the assets, the balance carried down is normally this side by the end. So that when you open the next period, you carry this figure and place it here as you open the next what? Period. So just back to in this case what we explained. We said when you have deferred tax liability, whereby in the question, in the trial balance, it is appearing on the credit side. That is the figure at what? At the start. In our situation here, it is appearing on the debit side, is an asset. In our previous two questions, they were appearing on the credit side. That was the liability at the start. I told you calculate. If you're given the temporary difference, you take 30%. If they are positive, then it means that as the deferred tax liability at the end. Then you compare the two figures, whether there is an increase or there is actually what? A decrease. That's what I was having to tell you. You compare with in this case, there's an increase, or there's in this case what? A decrease. We said if it is a deferred tax liability, if it is an increase, that is what? An expense. Right? You remember, if the deferred tax liability at the start is actually, for example, 10, then at the end of the period, you've calculated your 30% after looking at the TD, it is coming to 15. It means the deferred tax liability in the company increased from 10 to 15. They incurred more expense to pay taxes by 5 shillings. So it is what? An expense. And therefore, you'll be able to add on what? The income tax expenses. But I told you, if it ends up having to decrease, let's say, for example, it was in this case 10, then it goes to 5. That's like in this case, what? An inflow is like an income. That is under what? DTL. But now you have to take notes. Under now deferred tax assets, the opposite occurs. That's what I was having to say. If you understand what is happening, you can just think logically. For example, you can be able to see with the deferred tax asset, you can see at the start, the amount is actually what? Less. At the end, the amount is actually what? More. And it is bringing what? An income. But that is not our case in what? In DTL. DTL is the opposite. Under deferred tax liability, it means if it is increasing, that is an expense. With the deferred tax asset, if it is increasing, that is what? An inflow. It is an income. So in short, if you are a very clever student, in this case, you can just be able to write and say, in this case, if the DTL is actually increasing, that is what? An expense. Is an expense. If the deferred tax liability is decreasing, that is what? An income. That is what? An income. Then you go this other side. You say, this other side, you say, I can see you're not able to see there. I can see you're not able to see there. So we can just be able to rub this so that you can be able to see what you're having to say. So if you are a very clever student, as what I've just been able to explain, if you are getting what I'm having to say, because sometimes you might not end up having to do this kind of double entries, you can just think logically and actually say, like what I explained in our previous question, we were having to say, you compare the DTL at the start and of course what at the end. So if the DTL is actually having to increase, if the DTL is actually, the deferred tax liability is increasing in the year when you compare the start at the end, is increasing, that is basically in this case what? An expense. It is an income tax what? Expense. If the DTL, deferred tax liability, is decreasing, that is what? An income. That is an income. Then when you go to deferred tax assets, where the temporary difference is negative, remember this one, for this one, the TD, temporary difference, is actually what? Positive. When you compare the carrying amount and the tax basis, you'll get what? A positive figure. That gives you what? A deferred tax liability. When the DTA, when you go to the other side of deferred tax assets, if the DTA is actually in this case increasing, if it's actually increasing, then the opposite occurs. It is not an expense, but now in this case, it is what? It is an income. Like in our situation here, it is increasing from 33 to 36.3. It has brought us what? An income. That's why I'm having to say that this particular balancing figure, when it goes to the P&L, it will be on the credit side. So it means in this case, if the DTA, deferred tax asset, is having to, in this case, decrease, if it's decreasing, then now that will become what? An expense. It will become what? An expense. Because let's assume our figure here was 30. If our figure was not 36, it was 30, our balancing figure would have come this side. The P&L, this, what you're writing P&L, it would have, this balancing figure would have put it this side. When you go now to the P&L account, it would have actually been on the debit side, which it would have actually been what? An expense. It was decreasing from 33 to 30. 33 to 30. Then you have to take note that in this case, under deferred tax asset, the temporary difference is overall, in this case, what? Negative. Like what happened in our question here. The tax bases were more than the carrying amounts. It means our TD here was negative 121,000. So that is the logic of what is happening. So you can use this account, or you just think very fast here, like I'm having to say here. Once you have it in the month, the DTA is increasing an income, the DTA is decreasing an expense. So like that, you'll be able to know what is happening. So therefore, in this case, in our situation here, it was a deferred tax asset because you can see the TO balance. The opening balance you've actually been given is on the debit side. If it's on the debit side, assets normally have their balances on the debit side. You need to compare at the end of the period, is it having to increase or is having to do what? Reduce, so like that. Then in this case, you'll be able to know whether it was an income, it was in this case what? An expense. So in our situation here, you can see it was increasing because you calculated 30% of this temporary difference by the end is giving us 36,300. If you compare the two figures in the DT account, you're having to see 33, it was what? An increase, which will go to the credit side of the P&L account, which is what? An income, which is an income. You have to take note of that because I can tell you this concept of deferred tax, it will never miss in published. I don't know why the examiner will never miss to test it. He will never miss to test deferred tax concepts in published financial statements. He will never miss. He will never miss. He will never miss. But we've been able to capture this because I want to wrap so that I can be able to complete our what? P&L. So are you through? I need to wrap. 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 Are you through? Confirm that you're through. I want to wrap here so that we can be able to complete our P&L account. We can complete our P&L account. I can see you saying yes. I can see you are saying yes. I can see you are saying there, yes. I can see you are saying there, yes. So in our situation here, we have in this case 2 tax credits. So income tax what credits. So we have this profit before tax, we can be able to continue. So we have in this case shillings in thousands. So we in this case end up having to in this case add what our tax credit there. Our total tax credit will likely be 2 figures. That one for the current tax and that one for what? For the deferred tax, which in this case we've actually been able to get what? 3,300. So in this case, if we can be able to add, so let's add there. So income tax credits. Income tax credits will have 2 figures. So one of them was for the current tax, which in this case was an amount of 15,700. Is 15,700 plus 3,300. So this one is for current tax. This one is for deferred tax, as we've been able to calculate. Then it will overall be able to give us what? 19,000. So you need to add, you are adding because it's a tax credit, it's not a tax expense. It's a tax expense. You need to add, then in this case, you get what? The profit or loss. Profit or loss after, in this case, matters what tax. Profit or loss after matters what tax. What do you get? You get -41. Should be able to get -41. -41 like that. -41. -41. -41. -41. -41. -41. -41. So I want us now in this case, we quickly look at question number B. So that is the end of that particular part A. Let's look at part B, which is also still on what? Deferred taxes. Still on matters deferred taxes. Let's look at it very quickly because I want to wind up now. I want to wind up completely with the class. I want to wind up very fast in the next 10 minutes. I should be gone. In the next 10 minutes. We can look at part B. I should be going in the next 10 minutes. So part B of the same question. It says, on 30th of June 2022, Fora Limited had a credit balance on the deferred tax account. So that means it was what? Was it a liability or was it an asset? Francisca, if you are trying to understand what you are trying to discuss in our today's class, was that an asset or was it a liability? It was a liability because it was what? On the credit side. It was a liability. So on 30th of June 2022, Fora had a credit balance on its deferred tax account of 13,460,000, all in respect of differences between depreciation and of course what? Capital allowances. Then you are told during the year, this was actually at the start of the year. It was by the start of the year because it was in 2022. During the year ended 30th of June 2023, the following transactions took place. 45 million was charged against profit in respect of what? Depreciation. The tax computation showed capital allowances of 50 million. Interest receivable of 50 million was reflected in the profits for the period. However, only 45 million of interest was actually received during the year. Interest is not taxable until it is received. Then interest payable of 32 million was treated as an expense for the period. However, only 28 million of the interest was actually paid during the year. Interest is not an allowable expense for tax purposes until it is paid. During the year, Fora Limited incurred development cost of 500,600, which it has capitalized. Development costs are an allowable expense for tax purposes in the period in which they actually, in this case, they are not paid. Then land and buildings with a net book value of 4.9500 were revalued at, in this case, how much? 6 million. The tax rate is actually 30%. Fora Limited has a right to offset a deferred tax assets and a deferred tax what? Foreign limiters have a right to offset deferred tax assets and deferred tax what? Liabilities. So they have a right to be able to offset. Then in this case, you are called upon in this case to determine the deferred tax liability on 30th of June 2023. The deferred tax liability on 30th of June 2023. 30th of June 2023. 30th of June 2023. So in this case, what you can be able to do in this case, you can actually, because in this case, you say for you to calculate the deferred tax, you have to, in this case, determine what we call what? Temporary differences. We have to, in this case, get what? The temporary differences. The temporary difference. Of course, TD, temporary differences, is equals to the carrying amount minus, in this case, what? The tax base. Minus the tax base. Minus, in this case, what? The tax base. So therefore, you can have, in this case, carrying amounts, then you can have, in this case, the tax basis. The difference between the two, the difference between the twos, the difference between the twos should be able to give us, the difference between the twos should be able to give us, in this case, what? The TDs should be able to give us the temporary differences. The temporary differences. Suppose you have the first statement. The first statement there, you need to read it very carefully. Francisco, you need to be very keen as what this statement is having to say. So it says, 45 million was charged against what? Profit in respect of what? Depreciation. In respect of what? Depreciation. The tax computation showed capital allowances of, in this case, how much? 50 million. So in this case, you have, in this case, differences of what? Depreciation and of course, what? Capital allowances. So differences, the first one is differences in capital allowances. Differences in capital allowances and depreciation. So if you read this particular statement, what they're having to mean here, remember in this case, carrying amounts, these carrying amounts are the amounts the accountant considers when he's having to calculate the profits in the company. The tax base are the amounts the taxman will consider when he has to determine which kind of profits will likely be charged on what? Which kind of profits will likely be charged on, in this case, what? On tax. Or the tax, which profits will the tax be charged on. So the figures for the taxman are normally different with those ones of what? Of the accountant. That's what we have in this case, what? Temporary. We have some differences that arise with how the accountant does his accounting and the taxman does his accounting to know what are the profits to be charged, to charge on what? Tax. Those who have done public finance and taxation, they understand what I'm trying to sing and shout here. They understand. You normally in this case do what? It is allowables to get what? The taxable profits. The profits that the taxman, KRA, will consider to tax on are different with the profits that you, the accountant, there keeping the books of accounts, you are having to consider. Therefore, it normally brings about what we call what? Differences. For example, in our situation here, the person who considers depreciation is the accountant. The person who considers capital allowances is the taxman, because in tax, you will calculate capital allowances, you will say add back depreciation, then deduct what? Capital allowances. That's what the taxman considers. Loss of value on asset, he doesn't consider depreciation. For him, his language is what? Capital allowances. That is his language. And therefore, in this case, in our first question here, one here, we are told 45 million was charged against what? Profit in respect of what? Depreciation. So of course, to get the carrying amount of assets, we normally take what in this case? The carrying amount of assets, we take in this case, the costs, we minus what? Depreciation. While here, what the taxman will be able to consider, he will take the costs minus what? The capital allowances. Minus the capital allowances. So of course, in our situation here, we don't know. In this case, don't know ideally in this case what the cost. We can be able to say it was maybe X minus It was maybe X minus, in this case, what, 45. We can put all the figures, 45 million. You can put all the figures, 45 million, it was 45 million. Then also we don't know the cost here, maybe it is X minus, in this case, what, 50 million. So like that. So to get the temporary difference, we get the difference between what, the two. And then when you do, we can try to do this kind of mathematics here. You can be able to say X minus 45 million minus X minus 50 million. 50 million minus 50 million. So minus 50 million. So if you do this mathematics here, it will likely come to X minus 45 million minus X, but this and this one, it will give you like a positive. So it will basically be 50 million. When you open the bracket here, it will likely give you a positive. So this is what, minus X. Then this and this, when you open the bracket, it's like having to multiply this and this, it will give you a positive. So these ones will likely end up having to disappear, because when you take X minus X, you get what? It goes off. It disappears there. So if you take, in this case, 45, we'll have, this one would have actually been eliminated. So you'll have 45 plus 50. 45 plus 50, what do you get? 45 plus 50, positive 50, what do you get? 45 plus, you get a positive of what? Of 5. You get a positive of 5 million. You get a positive of 5 million. 5 million. You get a positive of 5 million. So it means in this case, our temporary difference in the first one will likely be 5 million. Alternatively, you can put an exaggerated figure here. Try to put an exaggerated figure here. Let's say, for example, in this case, the cost of the asset was 100 million. Let's assume it was 100 million. So to get the carrying amount, what do you do? Cost minus depreciation. Let's assume it was 100 million. If you put here 100 million, you'll get it is what? 55 million. It was 100 million. If you put here 100 million, here it will come to what? 50 million. Look, let's put an exaggerated figure. 100 million was the cost. If you put here 100 million, you'll get 55 million. If you put here 100 million, you get here what? 50 million. The difference between 55 and 50, you get 5. Get 5. So it means in this case, our temporary difference in the first one there, it was 5. It was 5. It was 5. It was 5. It was 5 million. It was 5 million. So you can actually be able to go to the next one, number 2. Number 2, what have we told in number 2? Interest receivable of 50 million was reflected in the books, in the profits for the period. In the profits for the period. Interest receivable, that is what? An asset. It's like accounts receivable. Interest receivable. Interest receivable. That is like in this case what? An asset. An asset. The interest receivable was reflected in the books of the accountant. These are the figures of the accountant. It was reflected in this case at what? At 50 million. At 50, is it 50 million or 50,000? 50,000. You need to be careful with those figures. We need to be careful with those figures. It was reflected at what? 50,000. Then you are told, however, only 45 million, 45,000 of interest was actually received during the year. Then there's that last statement. Interest is not taxed until what they received. It means what the taxman taxed was 45, not this one. This is what the accountant they showed in the books they are supposed to receive as an income, as an asset. This was the asset, but now it is never taxed by the taxman until it is fully received. What they only received was 45, and the taxman considered only what? 45. And then in this case, the tax base for this interest receivable was actually 45. Was 45,000. That's 45,000. It means in this case, our TP, our temporary difference there, will likely end up having to be 5. It will likely in this case be, if it is 5,000. If it is 5,000, you need to be careful with the figures there. They are confusing. You need to be a bit careful with the figures there. They are confusing. It is actually 5,000. It is 5,000. So the TP there, it is positive 5,000. So then in this case, we can go to number 3. Number 3. What are we having to be told in number 3? That Interest payable, now this one is a liability. Interest receivable is an asset. Now in this case, we have what? Interest payable of 32 million was treated as what? As an expense for the period. That's what the accountant considered. Interest payable. This one now is a liability. Interest payable. Interest what? Payable. Interest payable. This one now is exactly what? It's not an asset. Is a liability. It's not an asset, it's a liability. So the carrying amount in the books of accounts was in this case how much? 32 million. 32 million. 32 million was in this case how much? 32 million. 32 million. But now in this case, it was treated as an expense for the period. However, only 28 million of the interest was actually paid during the year. Interest is not an allowable expense for tax purposes until it is paid. The taxman only considers what was paid. So the taxman, his language was in this case to consider only what? 28 million because it was paid. And then we have in this case what? A difference of what? 4,000. So for this one, it is the opposite. It's the opposite. When you get a positive here for the liabilities, it will likely end up having to be a negative. So it will likely be 4,000. But now it will be negative because it is a liability. It is a liability. It is a liability. It's like having to offset it off from what? From the assets. You know, assets is like what you possess. But liabilities are the ones you're having to pay out. So it actually operates now in the opposite. You'll actually be able to offset it. If you get a positive, you actually offset it off as a liability. So it will be a negative. What? It will be a negative like that. So it will actually have a negative figure like that. Then we go to the next one. During the year, Fora Limited incurred a development cost of 500, 600, which it has in this case done not capitalized. It has actually capitalized. They have actually been able to include this one as what? As part of what? The cost of the asset. What they mean by having to, you know, in this case, when you're developing like a building or an asset, is it IS number 16? I think it could be property, plant, and equipment, something like that. It's actually, in this case, calls upon you as the accountant to capitalize the cost of having, for example, prepare the site or to be able to develop the place. You include them as part of the cost of what? Of the asset. And therefore, these development costs are what? An asset. But now we normally refer to it as what? As an intangible. You can't touch it, you can't actually feel it. Like the building itself is an intangible asset. So it has to be included as part and parcel of what? Of the total what? Of the asset. So therefore, in this case, you have what we call what? The development costs. Development costs. We have the development costs. So for the development costs here, you are told what the accountant had capitalized was 500, 600. Was 500, 600. Was 500, 600. Then you are told what? Which it has capitalized. Development costs are an allowable expense for tax purposes. In the period in which, in this case, they actually done what? Paid. In the period in which, in this case, they actually done what? Paid. They actually paid. They actually paid. So what will happen here? These ones, the tax base will actually, in this case, be what? Will be zero. So for intangible assets, for all the intangible assets, if you come across an intangible asset, it might be development costs or just any other intangible asset. And those who are in the class when we did income taxes, I told you, for intangible assets, the tax base is actually always what? Zero. Don't think twice. Just put there negative dash or zero. So it means in this case, because this one is an asset, it means you have in this case what? A temporary difference of 500, 600, like that. So that is the temporary difference. That is the temporary difference there, the temporary difference. You can continue. So for intangible assets, take notes. You can even write it as an NP. I'm sure in the notes also we wrote as an NP. For intangible assets, the tax base is usually in this case what? Is zero. It is zero. You don't have to think twice. So in this case, just put the carrying amount, then don't recognize any amount under what? The tax base. Then you'll be able to get what? The TD. Because it's an asset, then it means it will actually end up having to remain as what? As positive, like that. It will remain as positive like that. Then London buildings with a net book value of 4.9, 4,900, 500 were revalued by 6 million. So this one will likely end up having to use it in what? In the deferred tax account. But now in this case, we'll be determining the deferred tax liability by the end of the year. So we can in this case get our total temporary differences. You can in this case get our total temporary differences, our total TD. You can be able to add them. Just add them so that you can be able to get the total temporary differences. So the TD The total temporary differences by the end of the year. What are you getting? You need to add 5 million plus 5 plus -4 plus 500, 600 plus 500, 600. You're getting 501. Remember that you're getting 55, 01, 600, 55, 01, 600, 55, 01, 600. So 55, 01. It is a positive, it is up. So that is what the temporary difference. That is the temporary difference. That is the temporary difference. And then in this case, you can actually now in this case to calculate what? The deferred tax. You can now calculate the deferred tax. So therefore, the deferred tax now will be equal to deferred tax is equals to the tax rate multiplied by the TD. So the deferred tax is equal to the tax rate multiplied by the temporary difference, which is this one. So we'll in this case say 30%. You've been given a tax rate of 30%. So you'll take 30% multiplied by 55, 01, 600. What do you get? Is a figure you'll be able to get. 55, 01, 600. 30% of 55, 01, 600. 30% of 55, 01, 600. You get 1650, 480. 1650, 480. 1650, 480. 1650, 480. 1650, 480. 1650, 480. 1650, 480. So with this now, we can actually be able to come up with what? The deferred tax account. We can come up with the deferred tax account. So you can come up here through here because I want to wrap so that I can draw here the deferred tax account. Draw here the deferred tax account. And I have the deferred tax account there. So for the deferred tax account here, we have in this case our shillings, we have our shillings there, we have our shillings there, just to be able to comprehend it. We've been actually told there was a balance, in this case downward. There was a balance at the start of the year. So on June 22nd, so when the year was having to start, these guys had what? A balance, which was on the credit side. So it means the balance brought down was actually a liability. So this particular this one was actually a liability because it was on this side, it was on the credit side. So they opened in this case with how much? 1340, 600, 600. So by the time we're having to close the year, so the balance carried down because it is a positive. You can see our temporary difference we've actually been able to get is a positive. Meaning in this case, it will give rise to, in this case, what we refer to as what? As a DTL. Because it is a positive. While it a negative, it will have given us an asset. And if it means the balance carried down would have actually been this side. But of course, this one of ours is a positive. It is giving us what? A liability. For liabilities, at the end of the period, they always have what? A balance carried down what? This side. So in this case, it means we'll have in this case what? A balance. We'll have a balance carried down. We'll have in this case a balance carried down of that amount. This is the DTL. The deferred tax liability by the end of the period is actually that one. So in this case, the deferred tax there by the end of the period was actually in this case how much? 1650, 480. 1650, 480. 1650, 480. Then, if you told in this case, in any case, there was any form of revaluation, if there was a revaluation, because you have a revaluation there, the revaluation there, you always credit in the deferred tax what? Account. You actually end up having to credit in what? In the deferred tax, in this case, what? Account. So, therefore, in this case, it will likely increase the liability. You'll likely be able to credit it here. You'll likely credit it here. It will likely increase the liability there. You'll likely credit it here. So, you'll likely put the amount here. Put the amount here. So, of course, you've actually been given a valuation gain there of, it will likely in this case be what? So, deferred tax, you can say deferred tax on the revaluation gain. Deferred tax on the revaluation gain. Deferred tax on the revaluation gain. So DT on revaluation gain. So you likely in this case take 30%, multiply by our amount there is actually 6 million. It will be 6 million minus 49,500. So it'll be 30% of what you get. There's something figure you're able to get. It is 1050, 1,500,000 or something. 1,500,000 multiplied by 30%. 1,500,000 multiplied by 30%. 1,500,000 multiplied by 30%. What do you get? There's a figure you'll be able to get there. There's a figure you'll be able to get there. So 1 million multiplied by 30%. There's a figure you're supposed to get here. So it's the one you'll be able to predict here. The revaluation gain. The revaluation gain, you'll get 329,850. So 329,850. 329,850. 329,850. 329,850. 329,850. So I don't know which side is more. So which side is more? Which side is more? Which side is more? I think this side seems to be more. This side seems to be more. Because it will bring us something like 69. So this side is actually more. This side seems to be more. So this one is 0, 5, 14, 0, 7, 7, 6. So 1674.50. So 1674.50. And therefore it means it is actually able to give us what? A balancing figure to the P&L. A balancing figure to the P&L, or what we refer to as what? The income statements. the income statement, a balancing figure to the P&L or the income statement. So what is the difference? I think it is, you can get the difference. So 1670 450 minus 1650 480. 1670 450 minus 1650 480 is a figure you'll be able to get. You'll get 19,970. So 19,970. This one now will be able to go to the P&L account as what? As an income. Because it is on the debit side, it will go that other side as what? As an income. It will go that other side as an income. So we can finalize. Let's finalize by me having to give you a note. Write an NB about what? The revaluation gain. Write an NB, which is the very final statement before we go. Other than having to take a break, let's just finalize. Then we go home. We go home to sleep. We go home to sleep. We are feeling so dizzy. We just go home to sleep. We are feeling so dizzy. So we can write an NB about that revaluation gain. You write an NB just after this account so that you understand why we do this. So that you understand why we do this. Just write. Just write an NB. NB, right? Revaluation gains on assets. Revaluation gains on assets are taxed. Revaluation gains on assets are taxed. Revaluation gains on assets are taxed. At the tax rate given, revaluation gains on assets are taxed. At the tax rate given, are taxed at the tax rate given, and credited in the deferred tax account, 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 and credited in the deferred tax account. And credited in the deferred tax account. Full stop. Being right. Full stop. Being right. This is because revaluation increases. This is because revaluation increases. This is because revaluation increases the carrying amount. This is because revaluation increases the carrying amount. This is because revaluation increases the carrying amount of an asset. Revaluation increases the carrying amount of an asset. Increases the carrying amount of an asset. The carrying amount of an asset. But this is not realized, immediately. But this is not realized 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 immediately. And therefore taxable, therefore taxable. But this is not realized immediately, and therefore taxable in future, 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 and therefore taxable in future. So this revaluation gain you've gotten on an asset, it will not be taxed immediately. It can only be taxed, for example, when you sell that asset, so it will likely occur in future. So it will not actually, in this case, be taxed immediately. So, it will, of course, in this case, increase what? The deferred tax liability. The deferred tax liability, which in this case, you likely end up having to settle it in future. Maybe if you sell the assets. So it's in this case, a tax that you'll just be able to pay, but is not now, and pay it in future. The taxman will be waiting for you, but now you sell the assets. Because if you bought land now, then of course, in this case, you end up having to sell it in future. You would have actually, in this case, realized that gain on the land, then when the inflow comes in, is when the taxman will tax you there. For example, if you bought land 2 years ago, at a value of 3 million. At a value of what? 3 million. So of course, this land by now, it is maybe 5 million. You've gotten a gain of 2. Remember, in a company, what the taxman taxes are basically incomes. If your income increases, your profit increases, he ends up having to tax you. But in this case, if your asset value increases, that's like in this case, you normally recognize it as what? As other comprehensive incomes. But he won't actually end up having to tax that income immediately. He might just only be able to tax it when you have a real inflow on the sale of that asset. It's like a tax that in this case you've just postponed. It will be paid in future. You might not actually be seeing it, that in this case it's having to be settled there. But once in this case, for example, you sell the land because you bought it at 3 million, when you sell it at 5, the taxman is waiting for you. But when you get the gain now, he won't end up having to tax it like right now. He'll actually basically in this case tax that inflow when you get what? The real inflow in future. It's just like in this case, those other incomes you're having to be told, like interest receivable. The taxman only taxes it when you get the real cash in, So the same case, when you revalue an asset, your income has increased in the business because you get what you call a revaluation gain. But you won't tax it immediately. But let's assume you sell the land, the taxman will be there. It's like a tax that you've just, in this case, done what? Postponed. You just postponed it. But you just postponed it. He'll just be waiting for you what? In future. That's why we call them what? Deferred taxes. They are basically postponed into future. But in the real sense, it is a tax that is there, which you have to still, in this case, do what? Recognize it in the books of accounts. So we'll be able to credit it here, and that's how you end up having to treat it. So you need to take note of that because that is one of the trickiest part that in this case we're going to get. The examiner really likes having to bring revaluation gain in one of the additional informations there. So that's how you'll be able to deal with it. Then remember, intangible assets, the tax base is 0. Intangible assets, the tax base is 0. Liabilities, they operate the opposite way. The temporary difference, if the difference is now actually positive, you actually put a negative on what? On the liabilities, because they actually offset what is actually in the assets. They offset what is actually what in the assets. Liabilities is going into the negative. So they offset what is actually in this case as temporary difference on what? On the assets. That is very important. You take note of it. Very important. You take note of it. Let me just end there for now. So we'll meet next week on Tuesday lunch hour. For a revision session. Then again, we'll be able to meet 6 p.m. That's when in this case I start on cash flows. So I'm hoping next week we'll be able to finish up with public financial statements, because now in this case, we want to go to the othermost trickiest part. Which is actually what? Group accounts. So hopefully by next week we might start group accounts if we finished published. So I'm hoping we'll be able to finish. Otherwise, thank you very much. Have a good night. Enjoy your weekend. Stay safe. Enjoy your weekend and stay safe.